Something terrible is happening in Italy. And no, it didn't start yesterday. There was no single crash, no dramatic announcement, no moment when everything suddenly broke. Instead, Italy is changing quietly, slowly, almost invisibly. On the surface, the country still looks familiar. Beautiful cities, busy streets, tourists everywhere, cafes full, life moving on. But underneath that image, the foundations of the Italian economy are weakening, not collapsing overnight, but eroding year by year. And that's what makes this situation dangerous, because by the time the damage becomes obvious, fixing it may already be impossible. Today, we're going to talk about what is really happening to Italy's economy. Why growth has stalled, why young people are leaving, why debt keeps rising, and why this crisis doesn't look dramatic, but could define Italy's future for decades. Italy's economy looks fine until you look closer. At first glance, Italy doesn't look like a country in trouble. It's one of the world's largest economies, a founding member of the European Union, a global powerhouse in tourism, fashion, food, and manufacturing. But when you zoom out and look at the long-term data, a troubling pattern appears. Italy has barely grown for more than 20 years. While other developed economies expanded, modernized, and increased productivity, Italy largely stagnated. In real terms, average living standards today are not much higher than they were in the early 2000s. This isn't a temporary slowdown, it's a structural problem, and structural problems don't fix themselves. The productivity problem. No one likes to talk about. At the core of Italy's economic struggle is productivity. Productivity is simple. How much value an economy creates for every hour of work. In Italy, productivity growth has been weak for decades. Many Italian businesses are small, family-run, undercapitalized, slow to adopt new technology. This model worked in the past. It doesn't work well in a globalized digital economy. When productivity stagnates, wages stagnate, competitiveness declines, growth disappears, and once productivity falls behind, catching up becomes extremely difficult. High debt, low growth, a dangerous combination. Italy carries one of the highest public debt levels in the developed world. High debt is not always a crisis by itself, but high debt combined with low growth is a serious warning sign. Why? Because debt becomes easier to manage when an economy is expanding. But when growth is weak, debt starts to feel heavier every year. Italy spends a massive amount just servicing existing debt. That means less money for infrastructure, less investment in education, less support for innovation, less room to respond to future crises. The economy becomes rigid, fragile, constrained, and every shock hits harder. Young Italians are leaving, and that changes everything. One of the most alarming trends in Italy isn't found in GDP charts. It's found in airports. Young, educated Italians are leaving the country in large numbers. They leave for Germany, France, the Netherlands, the UK, North America. They're not leaving because they dislike Italy. They're leaving because opportunities are better elsewhere. Low wages, limited career growth, rigid labor markets, high living costs relative to income. When young people leave, the damage is permanent. The country loses. Future taxpayers, entrepreneurs, innovators, skilled workers, and the population left behind gets older. An aging population and fewer workers. Italy is one of the oldest countries in the world. Birth rates are extremely low. Life expectancy is high. The workforce is shrinking. This creates a vicious cycle. Fewer workers must support. More retirees. Higher pension costs, greater healthcare spending. At the same time, a smaller workforce means lower economic output, lower tax revenue, slower growth. Without reform, this imbalance becomes unsustainable, and reform in Italy is politically difficult. Labor markets that protect the past, not the future. Italy's labor market is deeply divided. On one side, older workers, stable contracts, strong protections. On the other, young workers, temporary jobs, low security, limited benefits. This system discourages hiring and innovation. Companies hesitate to expand. Young people struggle to build stable careers. Productivity suffers. Instead of rewarding skills and performance, The system often rewards seniority and connections. That may preserve stability in the short term, but it slowly suffocates long-term growth. The illusion of stability. Created by tourism, tourism hides many of Italy's economic weaknesses. Millions of visitors create the impression of prosperity. Busy streets, full restaurants, constant demand, but tourism jobs are often seasonal, low-paid, vulnerable to external shocks. Tourism alone cannot sustain a modern economy. It doesn't drive productivity growth, it doesn't build advanced industries, and it doesn't create enough high-value employment. When tourism becomes the main pillar, an economy becomes fragile. Bureaucracy, complexity, and slow decision-making. Italy consistently ranks poorly when it comes to bureaucracy and administrative efficiency. Starting a business takes longer. Resolving legal disputes takes longer. Regulatory complexity discourages investment. Foreign investors see risk. Domestic entrepreneurs face frustration. Innovation slows. In a fast-moving global economy, speed matters. And Italy is often too slow. Why this crisis feels invisible. Italy's crisis is not loud. There are no dramatic shortages, no sudden crashes, no overnight collapse. Instead, there is slow decline, quiet frustration, gradual erosion of opportunity. This makes the problem harder to address. People adapt. They lower expectations. They normalize stagnation. But stagnation is not stability. It's decline, just slower. Europe can't easily fix this. Some assume the European Union will solve Italy's problems, but the reality is more complicated. The euro limits monetary flexibility. Fiscal rules constrain spending. Structural reform must happen domestically. External support can help temporarily, but it cannot replace deep internal reform, and reform requires political consensus, which brings us to the final problem: political fragmentation and reform fatigue. Italy has experienced constant political change, short-lived governments, shifting coalitions, competing priorities. Reforms require long-term commitment, but political cycles reward short-term promises. As a result, difficult reforms are delayed. Compromises, watered-down solutions, structural issues persist. The longer reform is postponed, the harder it becomes. Why this matters beyond Italy. Italy is not a small economy. What happens to Italy affects the Eurozone, European financial stability, regional political balance. A weak Italy limits Europe's growth. A struggling Italy increases systemic risk. This is not just an Italian issue, it's a European one.